how long will the attack impact supply? And with us now to discuss is Matt Smith, ClipperData Director of Commodity Research. So I believe you were listening to the president as well. Did you get to hear him? So the president saying, it looks like Iran was responsible for attacks on the Saudi oil plants. The president also saying, he didn't actually think that oil prices had gone up that much today. What do you make of what has happened in the last 24 hours, and what does it mean going forward from here?
Sure. Well, initially, there hasn't actually been that much of an impact on the physical flows. And so we are still seeing loadings happening from Saudi Arabia. Everything's ticking along. But the big concern is how long is this going to last in terms of getting things back up and running. So they have storage. If everything can be fixed in the next few weeks, then we should see oil prices ease back lower again. And flows continue. And that's the big
But we don't know right now,
Well, that's the big challenge, is that we haven't heard anything from Saudi Aramco coming out and saying this is how long it's going to take. We've heard, rumors and murmurs, but nothing concrete from them. And so markets hate uncertainty. And so because of that, we've seen prices, open really strongly last night, as expected, but then they've held up really rather well today just because of that air of uncertainty. We're just not getting clarity on what is happening there. So until we get further clarity, it feels like we're going to see support behind oil prices here.
Hey, Matt, couldn't you make the case, though, that oil prices deserve to be X dollars higher from here permanently, because now we understand that drone attacks can cripple the global oil supply, potentially. Maybe a little strong, but certainly impact it. I mean, whether it's the Middle East or Louisiana or Texas, for goodness sake, right?
Yeah. Last week there was all these pockets of geopolitical tension, but we weren't at the situation where you could see half of one of the world's largest producers come offline like that because of a drone strike or missiles or both. And so because of that, yes, there's the potential that we do see this risk premium in place, because there's always going to be the susceptibility of a
you can't. You need like a missile shield on oil producing areas. Forget it.
And we've had talk of the Strait of Hormuz, where we see a lot of this Middle East crude pass through, sort of 20 million barrels a day, the fear of that getting blocked. But that would be a temporary thing.
Yeah, the pirates seizing ships and that kind of stuff, or blowing one up or something, right?
Yeah, but that's a temporary thing, whereas this situation here, we still don't know if it's how temporary it actually is, and so it is a real going concern.
Matt, we saw a number of smaller U.S. Oil and gas producers, their stocks were up huge today. Whiting stock was up 50%. And I think the market there is looking at this and saying, well, if the price of oil is higher, then some of these more flexible shale players are going to get more aggressive. They're going to bring rigs back online. Do you think that could potentially almost put a cap, a ceiling on how high the price of oil goes? Because even if we have more of a risk premium in the price going forward, there's still going to be plenty of supply, because these companies are able to hedge out their production such that it makes sense for them to come back online.
Yeah, very much so. So I think part of the rally today as well was the consideration that you see some of these guys getting in there and hedging at that high price, taking some of that risk off the market. We have to remember that back in December of last year, WTI, the US benchmark, was at $42. And now it's at, was it 55, last week, and now we're pushing 60s and that. So this is fairly good times for these guys. And so it's no surprise to see that price rallying, but there should be that oomph behind it in terms of the production. We see production rising, about 1 million barrels a day on a year-on-year basis, and this by no means is going to stop that.
And then just maybe on the shale play, I remember back in 2014-15, there was so much discussion about what the break-even price is for some of these guys. From your work, what number to you seems like the number at which many oil producers, shale oil producers here in the U.S., are motivated to continue producing?
It depends, because the shale plays vary so much, even within their own sort of spaces there. And so, but a price around the kind of 40s seems a kind of fair kind of benchmark price there for these guys to keep on going, hunker down, and keep producing. And so anything above that really is kind of gravy.
Matt Smith, Director of Commodity Research at ClipperData. Thanks so much for joining us.
Thank you.